Well, it is Q&A time here again on the channel. Just yesterday I put up a community post to collect your questions for this video, and we've had some great questions come through, so thank you to everyone who did ask one. If you want to ask a question in a future Q&A video, just turn your post notifications on. I think that's what they're called here on YouTube, and that way you should be notified every time I release a video and every time I put up a new community post when I collect your questions. I usually try to do these videos about once a month. So I'm going to roll the camera for 20 or 30 minutes here and basically just see how many questions we can get through. But before we get into that, we do have a sponsor for today's video, and this video is sponsored by Hatch. Hatch is the platform that I personally use for all of my US investing for me as a Kiwi based here in New Zealand. Hatch is asking you to think about what your big and small tomorrow goals look like. For me, the goal has always been financial freedom, putting a little bit away today with the aim being that I can do the things that I want to do tomorrow. Everyone's tomorrow looks different, whether you want to buy your ultimate dream car, travel the world, or become financially independent. Reaching your goals starts by taking the first step. That's why I invest with Hatch, to help make my plans a reality. If you want to get started investing with Hatch, check out the first link in the description where you can get a free $20 New Zealand top up when you make your first deposit of $100 New Zealand or more before the 31st of December 2022. Okay, so first question here is from Frank. What are some of the key quantitative metrics you look for in a bank? Buffett has criticized the price-to-book ratio for banks, yet many investors still default to that. What are the better alternatives? Yeah, so I saw this question last night, Frank, and I actually went and watched some old Buffett clips and Buffett interviews on CNBC where he got asked about banks trading at below their tangible book value and so on, to try and get a feel for what Buffett's thought process was here. As you know, I've been digging into banks a little bit recently, so always keen to understand what Buffett thinks of kind of bank valuation. And basically what Buffett said is that at the end of the day, what matters to a bank is earnings. But he then went to talk about sort of return on assets, and if a bank can generate a high return on assets, they will tend to trade at a high multiple of book value, and if they earn a low return on assets, they will tend to trade at a lower price to their tangible book value. So I guess valuing a bank, theoretically at least, is valued the same way you would look at any other business. What you're trying to do is buy a stream of cash flows, and therefore the intrinsic value of that particular bank, just like any other business, is the present value of future cash flows. Now, of course, the nature of banking makes it a little bit tricky to run discounted cash flow models and things. So I think looking at some of the characteristics around book value and sort of partnering that up with return on assets and return on equity can give you a good understanding of what the future earnings or normalized earnings might be. So if you take an example bank, and let's just say hypothetically you can buy it for a price to book of 1, you sell it a few years down the track for a price to book ratio of 1, it doesn't pay a dividend and doesn't buy back any stock, it just kind of reinvests all its capital for simplicity's sake. What will really matter to you in terms of your return is what the long run return on equity is for that business. If the return on equity is 15% and the multiple doesn't change, and like I say, there's no kind of capital paid out to you as a shareholder, then your return will be 15%. And a return on equity is, of course, the net income earnings divided by the book value or the equity in the business. So I guess earnings fundamentally is what matters, but the way that you inform what you think those earnings are going to be when you do an analysis is you look very strongly at the balance sheet. You look at the loan assets that the bank has, maybe an equity portfolio the bank has, and you try to understand the kind of cost of their funding sources through deposits and so on. So balance sheet is incredibly important. I still think book value is very useful, but at the end of the day, I guess Buffett believes that earnings are what matters, and that seems to make sense to me. So thanks for your question. Next one here is from Gage Sanchez. How do you balance the quantitative and qualitative aspects of a business in your analysis? Do you require profitability, or are you open to an unprofitable business with a future growth / profitability story? I know Guy Spear has discussed unlearning the classic quantitative metrics he analysed over the past 20 years. Would love to hear your thoughts. It's a good question. I think many of the quantitative metrics still are important. We just talked about price to book in a banking context, but there are definitely businesses where things like price to book are just unimportant. You know, the earnings for a bank or from a real estate company are very strongly generally influenced by what's on their balance sheet and by their book value. But there are several businesses that can earn a lot of money, particularly software companies, without a whole lot of tangible assets. So of course, for some businesses, different metrics are more important than others. In some, you can still be very quantitative. So if you're looking to buy a net, or you are looking to buy something like a bank where those physical assets are very important, the quantitative aspects still matter a lot in my view. If you're buying a faster growing company that maybe isn't yet profitable or will benefit from a lot of operational leverage, in other words, their revenue can grow a little bit and their earnings will grow kind of much faster than that because they're getting over this big base of kind of fixed costs. I think, again, the quantitative numbers will still matter, but you probably want to have more of a qualitative understanding of what types of things are actually going to allow that business to grow moving forward. So that's the way that I kind of think about that. I have invested in unprofitable companies before, but generally they have been backed up by a lot of hard assets. So they still sort of look undervalued through a traditional lens like that. Okay, next question here is from James. If you could pick one investor who has to file a 13F that you could call once a month to talk stocks with, who would it be? That is a really tough question. I think if I was going to talk stocks with someone and they're a money manager managing more than 100 million, there's a few that kind of get on my short list, I think. Buffett and Munger would just be amazing. Probably Lee Lu would be pretty epic as well. Obviously Guy Spear and Mohnish Pabrai are all up there too. If I had to pick one, I've just recently listened to Mohnish Pabrai's recent episode with William Green on his podcast, and it sounds like Charlie Munger would be a pretty good guy to be able to discuss stocks with. So assuming that Charlie is going to be around a few years longer, probably Charlie. Maybe I'd go to someone like Lee Lu after that. I really just say that because I feel like I have a reasonably good understanding of how the analytical process for a lot of these investors really looks with Guy Spear and Mohnish Pabrai and even Buffett to a certain extent, but Lee Lu is a bit more of an unknown, and I think you might get a kind of different perspective from Lee Lu. So I think that would be a cool one. So thanks for your question. Next one is from AB. How do you deal with the internal conflict of adding a new position or adding more to your best ideas already in your portfolio? Good question. I think I try to just add to the thing that I think is most undervalued or will generate the highest return, kind of incorporating the risk that I think I'm taking in that investment. But you kind of, you obviously don't want to be all in one stock or all in two stocks. So there is a point at which you have to kind of cap those upper limits, but it can be challenging. I think if there is maybe a couple of stocks that I really can't decide between, you can pick both. You don't just have to put all your new capital into one stock continually if you think it's a really close race between maybe your top two best ideas being equally undervalued and have equal levels of risk and so on. So that's kind of how I think about it. I think moving forward, I probably do have a upper limit of maybe 10, maybe 15% of my net worth at cost in a single stock would be a pretty kind of huge position for me now. So that's sort of a mental upper limit that I have. So once I hit that, I would kind of look to add to a new idea. But hopefully the net worth is going up over time, and those previously added positions are kind of getting diluted down and because of that. So it means that I could potentially add to stuff that I bought, a couple of years ago or whatever. So that's kind of how I think about it. The other thing is, you obviously want to have some degree of diversification, and there will be variation between different people in terms of where you're comfortable with concentration versus diversification, but you also don't want to be diversified to a point where you just can't keep up with the businesses if you have a day job as well. So those are some thoughts on that. Hopefully that helps. Next question is from Quant Compounder. Monas explains reasons for exiting SRG in the latest Richer, Wiser, Happier podcast episode, which is a great episode. Definitely recommend checking that out. As a super investor you highly respect, what is your take now on the stock during this downturn? Yeah, it's a good question. I guess Monish basically listed kind of two core reasons around why he exited Seritage. Firstly, he thinks he really underestimated how difficult it would be for Seritage to get kind of approval from local regulators and so on to do the developments that they want to do, and the process is just dragging out over a much longer period of time than he initially thought it would. And the second concern was basically with management. So I don't really have any great value to add in terms of the management comment. In terms of kind of the zoning issue and the development sort of timeline and how long that might take, it's definitely, I think, taken longer than some people have expected. I would also say that, Monish has previously said that he went into Seritage with sort of a 10-year view, where he thought that they might go from 170 properties down to maybe 30 properties, and those 30 properties would be fully developed, and there would be cash flow coming off those properties and so on. And he was taking a very, very long-term view, and now we're sort of 1 to 2 years, I think, after him saying that, and he's reversed course. So I don't quite know how to kind of compute that. And the other thing to keep in mind is, since Monish has exited Seritage, there are kind of a couple of key things that have changed. The big one is that Seritage are now potentially pursuing some sort of transaction. We don't know exactly what that's going to look like, and Seritage management, I must say, have been awfully quiet around that. But potentially we're going to see some sort of deal where a big chunk of the Seritage properties get sold off in one hit, or maybe Seritage even in its entirety gets sold. And I think that could be a situation that could be very beneficial, particularly in the short term for shareholders. I think the long-term vision is still, if they could develop the entire portfolio and have a portfolio of cash flowing properties, then that would be the ideal. But I appreciate that the current environment is making that kind of more and more challenging. So if they were to be able to sell the real estate, even at a fire sale price, I think shareholders are likely to do reasonably well from here, but do your own work on that. I don't think there's many people that would argue that Seritage isn't undervalued today if you were to look at the real estate and back out all of their debt, but there are cash flow concerns. They have a big debt payment due next year, about 800 million, maybe a little less than that now because they've paid off some, but close to 800 million due to Berkshire mid next year. And we're also in an environment now where interest rates are rising very fast, the cost of debt is rising very fast, and at some point that has to have a gravitational pull downwards on real estate prices. And since Seritage is leveraged to those real estate prices, that can have a enlarged impact on the price of the equity, the price of the stock. So there are some headwinds for Seritage for sure, and it has been beaten up. I think it's down over 50% now year to date. So it's had an absolute hiding, but those are some of my thoughts on it at this stage. So thanks for your question. Okay, next question is from Ang, and I hope I'm pronouncing your name correctly. Apologies if not. How would you value a growth stock in general? How much is too much? Yeah, good question. So I tend towards a discounted cash flow type approach for what most people might call a growth stock. I guess you have to understand that I don't, and a lot of investors don't typically categorize things as value stocks or growth stocks. All things being equal, a company that is growing at 15% and earning good returns on the capital that they're investing to do that, all things being equal, a company growing at 15% has a higher value than a company growing at 0% or a company that's shrinking. So growth is sort of a part of the value equation, and from a technical perspective, you can capture that through something like a discounted cash flow. Now, you do have to be cautious with those things. If you, particularly when you are valuing higher growth companies, a small change in growth rate can have a huge impact on the kind of number that will drop out of the bottom in terms of what that business is worth. So you have to be cautious a little bit with the growth rate assumptions that you're making. Ideally, you want to have conservative growth rates, and ideally you want to buy that stock at a big discount to the sort of intrinsic value price that you're calculating. But that's the way I would do it. If you just go on my channel, a couple of the most popular videos I have are around how to go through that process. So appreciate your question. Next question is from just one, do you perform Scuttlebutt? And if not, how do you judge whether statements in reports reflect the reality? Yeah, so I guess Scuttlebutt can come in many different forms, but I certainly try to do that where possible. You know, whether it's going to the US and having a meal at Texas Roadhouse, for example, or whether it's something as simple as you know, watching previous annual meetings and Q&A sessions with management at a company, or looking at customer reviews on websites. It really depends what industry you're looking at, but I certainly do try to do that. And I don't know if I would really classify that as helping me with whether financial statements make sense or anything. I'm just trying to understand, you know, why people would purchase a product from that company and whether they are likely to do so again in future and that sort of thing. So hopefully that helps. Next question is from Luis. What is your favorite stock market related movie? It's got to be The Big Short, I think. That's a fairly easy answer for me on that one. Okay, let's take one last question. This one is from Zach. What have you found to be the best and most effective way to detect and assess whether a company actually has a moat? Are there certain numbers and metrics you look at in financial statements, or do you find the necessary information in annual reports, for instance? Yep, again, it depends a little bit on the company. So if it's some sort of consumer-facing product, like, you know, let's take Apple, for example, or McDonald's, you can see that pretty clearly in the brand that they have and in the long-term track record of the business, frankly. You will tend to see long-term growth, high returns on capital, expanding margins, which means that they are able to generally charge more for their product over time if they've got expanding gross margins. And if they've got expanding operating margins, then, you know, they're benefiting from that growth and a bit of operational leverage. So generally you can see it in the financial statements with a lot of those types of companies. If it's more of a commodity type business or a bank, maybe you're looking for a bank that has lower than average cost structures, and they're able to provide money to people who need a loan, or they're able to provide a commodity to people at a lower price than their competitors. That would be another form of a moat. Or maybe it's some sort of regulatory moat. Maybe it's a military business that has government contracts and has done for a long period of time. There's a lot of different kind of competitive advantages that you can have, and a few different lenses that you can kind of look at that business through. But at the end of the day, it should be showing up in the financial statements in some form over a long enough period of time. So hopefully that helps, and I appreciate your question. So that's really all we've got time for this one. I do hope you enjoyed the video, and like I say, if you want to ask a question in a future Q&A video, just keep an eye on my community post page, and like I say, I try to do these about once a month. So if you've got notifications on, you should see me put that post up there in a month's time and be able to get in there quickly with your question. But that's all I've got for this video, and I will see you in the next one. Cheers.